Have we pressed record? There we go. So starting now, it is being recorded and it will be posted, this session, on the Kerry's Place website, and you will all get a copy of it as well as these slides. So that's sort of the ins and outs on how it works. And in terms of questions, there's a variety of ways that you can ask your question to get it answered. The most direct way is right in the chat. And I said this earlier while we were all waiting around for this to start. The chat button is at the bottom of your screen. If you're not that used to Zoom, you hover around the bottom of your screen, you should see it there. Just click on that, you will see the chat, the conversation going on online. And Karen Christie, we are very, very, very lucky to have Karen, who works with Ken Pope, answering questions for you live while we're all talking about some of the issues that you want to know about. That is, if they're not too detailed. If they're about Kerry's Place processes, Osman will be able to tackle those questions in chat or live. And we're also going to handle the questions that came in earlier on email live in the Q&A. All of you are going to be muted through this, including me, for the most part, so that there's lots of bandwidth for our speakers. And when it gets to Q&A, just raise your hand and I will get to you. That's an icon as well under the reactions button on Zoom. If you check there, you'll be able to see a raise hand icon. That's how you tell us that you want to say something. And we're going to give you these links many times tonight, but these are the important ones. That's Ken's web information is right there. And Kerry's Place related questions go to that info@kerrysplace.org. If you have questions that are not been answered tonight through all of this, that's one of the many ways you can get your questions answered. Next slide. So we're gonna hit this going. We're gonna get this going now to the income section, and I'm gonna throw it over to Ken.
Okay, thanks very much. I appreciate your introduction. My law practice deals with all of the matters that we're discussing this evening. And just to give it context, if you look at the number of households in Ontario, you take the population and divide by 3, and StatsCan says that's the number of households. Well, if you do a simplistic calculation based on the real numbers of ODSP recipients, plus a calculation of the people under 18 and over 65, which many of the Kerry's Place people will be soon, it turns out it's 1 household in 10 that is the parent or sibling household of a person with special needs, which is mind-boggling. And to give it some context, the baby boom, the peak of the baby boom, turned 65 in 2021. And of course, that's all of us. So a lot of people, when we get to the OAS GIS section, all the baby boomers are turning 65. As far as income, I expect most of you know that there's the Ontario Disability Support Program, and there's a basic room and board amount, and then there's also this 1308 institutional amount. It also comes, obviously, you'll see, with drug and dental and medical coverage. And this amount is paid, as you can see, to Kerry's Place, and some of the money is set aside for incidental purposes. But Kerry's Place provides the bulk of the support. And again, I'd like to thank Lisa for these slides, because it'll save us a lot of time. A lot of them are self-evident.
Thank you, Ken. So I'll take it from here. The Ontario Disability Support Program, or ODSP as we all know it here, as Ken alluded to, does include both drug and dental benefits. Now, drugs that are generally listed under the Ontario drug benefit are covered. However, some drugs that are considered non-generic or considered niche, There are some instances where this may have to be paid by the family or the guardian. The Ontario drug benefit would only cover a brand name medication if it falls under two categories. The first of which, there had been adverse effects with the generic brand. The second being that there is no generic brand that is available. Further to that, ODSP also does provide basic preventative dental care coverage as well, and that would cover your day-to-day dental needs, including cleanings, fillings, etc. So a very big question of why we're here today is what happens when an individual turns 65? Well, there's a lot of things that happen here. So just to paint the picture for this group here, about 30% of the residents at Kerry's Place are over the age of 50. So this is something that Kerry's Place is going to have to tackle over the next decade or so. And we have committed here at Kerry's Place to support families and guardians with this transition process from ODSP to other mechanisms of support well in advance of their 65th birthday. So I'll say that again. Kerry's Place has committed to working with families to support with the transition to other forms of support from ODSP into the two main drivers of support that you see here from a financial standpoint, which would be the Old Age Security, also known as OAS, and the Guaranteed Income Supplement, also known as GIS. And families will be assisted in completing these applications when the time comes. A good tidbit I wanted to share here today is that OAS and GIS combined are actually slightly more than the ODSP benefits when you're looking at them on an annual basis. The OAS and GIS benefits total about $18,500 a year, whereas ODSP, the institutional amount that was spoken about earlier, is capped at about $15,500 per year. When an individual does turn 65, the benefits that they receive in relation to medication will stay the same, and it is still going to be governed by the Ontario drug benefit. And as of May 2024, those who are over the age of 65 will automatically go on to a new federal program called the Canada Dental Care Plan. There's been a bit of a staggered approach to this, and that it had been released late last year, and they're starting with individuals that are over the age of 80. However, we have received notification that as of May 2024, all Canadians over the age of 65 will automatically be transferred onto the Canada Dental Care Plan. So there will be a registration process involved, and for the individuals under our care who are eligible for this plan, we will be supporting them with completing these applications to ensure that they are registered for the Canada Dental Care Plan.
If I could interrupt just for a minute, a couple of people joined while Osman was speaking, and we've muted you. And if you have joined in the last couple of minutes, we're now at 77. We've muted you, and and we'll unmute you when it's time for questions and answers. All right.
So now I'll pass the floor over to Ken, who's going to take us through some income tax tips.
There are two main credits. There's the disability tax credit, which certainly applies to people who are being cared for by Kerry's Place. This disability tax credit has to be approved by Canada Revenue. You have a form, a T2201 form completed. I wouldn't just leave it to the doctor, although in Kerry's Place situations, everyone I believe would qualify and probably has been approved. As you know, then we will see later, this means that someone can have a registered disability savings plan. We do still find that there are a number of families who are not using the disability tax credit. So what I suggest, if you're not quite sure, because that's unsure is a common reply to our queries on our intake form, is take a look at line 31800. 31800 is the disability credit transferred from a family member. And if you don't find anything on 31800, then it would appear you're not using it. If that's the case, it can be backfiled or adjusted for up to 10 years. And the most common slippage that we find is that people believed or were told that when their child went into a supported living environment, that they could no longer use the disability credit, which is not true. As long as you help to some degree with food, shelter, clothing, and of course it probably won't be shelter, But if you have your child home with you regularly and you provide them with seasonal clothing as required, then the credit is still transferable. And retroactively, it could adjust as much as $16,000 of taxes. Next slide.
Maybe we hang on there. Yeah. Okay. This slide that's up now, we went through it very, very quickly. Ken was talking about it, but we didn't see it. So maybe we should reiterate, because a lot of people don't know you can transfer the disability tax credit to the people who are on Zoom tonight. The family member can claim this on their own taxes. And as Ken was saying, that can reduce your taxes owing by reduces taxes owing, by $1,000. All right. And that also is a link to the RDSP, which we're going to get to in a bit later. All right, go ahead, Osman. Sorry.
I have one anecdote. What we find is that when people pass on, we're often contacted because there are Henson Trust provisions. And so we do our intake process. And we often find that, especially older clients, parents, haven't been using the credit because they thought they couldn't. So we readjust it for them as against their estate. So if you happen to die and you weren't using it, we can probably still do it.
All right. That's really encouraging. Thank you. And Osman, you can flip forward, I think, a bit more.
Yep, so I think this is the slide that we're on at this point in time.
Yeah.
And it's just to provide a quick overview of how taxes are done here at Kerry's Place for the individuals in our supported living program specifically. So there are two ways that the income tax would be filed on behalf of a person supported. The first of which would be the family member or the SDM taking the lead with filing the tax return on behalf of their loved one. The second option would be for the SDM to provide authorization to either a manager or the liaison to support with attending a local tax filing clinic. The staff in any case would support with gathering all of the documents involved, including rental statements or T5 statements. And to provide some context, the T5 is the statement of their ODSP benefits to support with filing their taxes. Many of the individuals that we support are filing basic tax returns that would include the rental costs and their statement of benefits from ODSP. And in those instances, we are able to find local tax filing clinics that would complete their tax return for them for free, understanding that it is a basic tax return. Notices of assessments would be sent to the address that the CRA has on file for that individual after the tax return has been assessed. Now, we do understand that there are some families that are interested in claiming credits or contributing to an RDSP. And I do know that for families that are looking for some more complex support with preparing an income tax return, we would recommend those families to seek support of a tax professional. And now Ken will guide us through the caregiver tax credit.
One of the most missed credits is the caregiver tax credit. If you happen to be using the disability tax credit, then there's no question that the caregiver credit applies. The caregiver credit is not something transferred from the person to you. It's your credit because you're the caregiver. It's used on line 30450. So if you want to check your tax return, check line 30450. And many people aren't using it. Yeah, partly because they don't know about it. But the other is that until 2017, you could only use the credit if the individual resided with you, which of course in this case they don't. So until 2017, it would be true that you couldn't use the credit. But then in 2017, they removed the reside with criteria. So if anyone isn't using it, we can adjust it back for 6 years. And recaptures about $1,000 a year. We used to do a fair bit of this, but people have learned over the last couple of decades. So we don't see as much of it as we used to. But still, it's obviously something we have to check on our intake form. And when you do find that there's up to a 10-year recapture. Well, that's very nice because you can recapture up to 10,000. And this is the other credit that we would recapture for the estate if someone has passed on.
Bob Stellick has a really good question that I think a lot of us have, so I'm going to read it out on the chat. I'm not sure what helping would be construed as. For example, my brother comes down to our house 1 weekend a month, but beyond gifts and clothing, we don't do anything else financially. So what's sort of the bar for being a caregiver under this?
Yeah, that's always the question. The Income Tax Act doesn't define caregiver or what care is. But if the person is approved for the disability tax credit and it's being transferred to someone, the transferability is based upon Canada Revenue agreeing, because you told them so, that you help with necessities, food, shelter, clothing. You don't help with shelter. So it's a question of, do you help with food or clothing? And if you regularly, for example, have a family member come and stay with you for a period of time, you feed them, then that's of course providing food. And so therefore this would, automatically allow you to use the caregiver credit.
And is it just you just say to Revenue Canada, I do this? Do you have to prove that you buy X amount of clothes or food per year? Any proof?
No.
Okay.
Okay.
All right.
Staying with Ken here for the Registered Disability Savings Plan.
Yes.
Okay. Is there another slide about the 1,500 and the 4,500? Or shall I touch on that?
I believe there are slides about that.
I think it's coming up after the RDSP, I think.
Okay, that's fine. So you can see here, as again, Lisa has done a great job on these slides. The Registered Disability Savings Plan is a plan that is owned by the child. And there's a misconception that it's kind of like an RESP that belongs to the parents with money set aside for the child. So people regularly ask if upon the parent's death, if the RDSP falls into the Henson Trust in their will. And no, it belongs to the Kerry's Place resident. They are described as the beneficiary, which is slightly misleading because it's true, they are the beneficiary, but they're the owner. Now, if a person is not competent, which would be the case here, then a parent, or now more recently, a sibling, can be the account holder on the RDSP. And as you'll see on the slides that come next, if you contribute up to age 49, the year in which someone turns 49. So if your family member is over past the age of 49, then there are no grants and bonds for them. But up to that age, if you contribute $1,500 over a 20-year period, it's not from age 18 to 49, it's 20 years. So to age 38, if you contribute for 20 years, $1,500 a year, the government puts in a $3,500 a year grant. And even if you had contributed nothing, the government contributes a $1,000 bond. I don't quite know why it's called a bond, but it is. And you can see here from the slide that over the 20-year period of contributions and grants and bonds, the family contributes up to $30,000 a year. Government puts up to $90,000. And as you'll see on another slide, if a person were to start this at age 18, then based upon the child's income, because of course prior to that it's the household income of the parent typically, on the child's income, they get these maximum grants and bonds. And one of the most critical things that is often slipped is to invest this money. We regularly still come across people, it's absolutely terrible, where back in 2009, they set up an RDSP for their child. They made all the annual contributions, but it was set up with a bank and they received no investment advice and they were blown away by the grants and bonds. And 10 or 12 years later, the growth since inception is 0.1%, which obviously is stupid because inflation was 2 and now it's higher. So what's happened is over that time period, you've lost capital value. But if you have invested it, and let's say it was invested at 5%, what you'll find is that when the person starting at age 18 reaches age 60, at which point they can start to withdraw, it will have grown to be about $700,000, which is massive. This has never happened before. It's never been the case that someone who's not competent will turn 60 and have $700,000. This was implemented just at the end of the last federal conservative administration by a conservative minister who unfortunately passed on. But he had a son with disabilities, so he had an affinity with the situation. And this is a wonderful thing. And a very interesting thing too. You can see that if somebody's in Kerry's place, their other needs may be modest. And if they had wound up with a $700,000 RDSP and turned 60, and then started to receive under the standard formula the payments, they would receive $30,000 over a year, over a 23-year period, which has never happened before. And this money may well not be required by the individual, and it would then accumulate. And because everyone's involved here is not competent, when the child finally passes on, they'll die intestate, no will, with a very substantial estate. This has never happened before. And by intestacy and succession law, it'll pass to their siblings, if they have siblings, or to the children of the siblings, if they're deceased. And then if not, there's a succession law, a tree, that indicates where it goes up to aunts and uncles and then drops down to their children, the cousins. It's very interesting. It's never happened before. Next slide.
Well, before you go to the next slide, talk about how the payments go at age 60. I mean, we want you, if your person is between 18 and 49, even before this thing ends tonight, you should be running to a bank and opening up an RDSP account. I mean, it's such an incredible program. What happens at 49? They're out of luck, right, Ken?
Yeah, no more grants and bonds after age 49.
But can they open, is there any benefit to opening an account?
We do sometimes as a tactic. If the person is over 49, let's say they're 58, and that means the parent's 88. And then the parent dies and the parent does not have a Henson Trust in their will, then you could put up to 200,000 of an inheritance into the RDSP so that the person doesn't lose ODSP benefits. To do this and effectively manage it, a sibling can be the account holder, but when the day comes that the person's 60, all the checks are issued in the name of the beneficiary. So you almost certainly need someone to be their legal guardian, which we come to later, in order to receive these checks, set up a bank account in the person's name, because the checks are payable to the person, and then to administer these funds for whatever their needs are, or to invest them and let them accumulate and pass by succession law to their siblings.
All right. It's a good segue to how the payouts go. So starting at 60, if you could pick up with how that works.
It's very simple. It's very simple. The LDAP formula says that what happens simplistically is that the amount is paid out equally over a 23-year period. So that's where the 30,000 a year comes from. It's the 700,000 capital that may well have accumulated. And then the simplistic calculation is about 30,000 a year for 23 years. You can see that, however, at present, there are lots of people that are turning 60, given that RDSPs were set up in basically December 2008, but let's say 2009. That's 14 coming on 15 years now. So if somebody's 60 now, 10 years ago they were 50, and the last grants and bonds are age 49. So you can see that there's only several years of grants and bonds. So you're winding up turning 60 with $30,000 or some such amount, divided over 23 years. So at present, people are just learning the RDSP sections of the banks also don't really quite know what the hell they're doing because they've never had the opportunity to do these things because nobody had turned 60 with grants and bonds. So we're in the process of educating the estate sections for all the banks. The estate section is separate from the RDSP section, which is separate from the bank branch. And they're having a lot of fun. We're having to explain to them that when the person has, if they pass away, either after 60 or before, with these modest amounts, or in a lot of cases with non-vested grants and bonds, the money that's left is a modest $30,000, $40,000, $50,000 in a lot of cases. And the banks are all saying, the estate sections are all saying that you have to have a probate application, which is, of course, is just a knee-jerk response and is not the answer. So we're dealing with these day to day, and
So it's still new. The headline is it's still new, and if you don't get good response from the RDSP departments at the banks, I guess they can contact you or others for additional
that's the simplest. Because of course the client doesn't know. The bank says probate, and you don't know better.
Yeah. And the other big headline is that and that's questions have been asked on email. RDSP payouts are 100% exempt from the ODSP income test, meaning none of their other income is affected by the RDSP.
That's correct.
Yeah, that's a big headline. All right, moving on.
Moving on. Thank you, Lise. Thank you, Ken. Now I'd like to take the opportunity to move into our next segue or next section of this town hall here, and we'll be focusing on passport funding. And I would like to call up Cody Miller, our passport coordinator.
Thanks, Osman. Good evening, everyone. So lots of stuff to get through tonight. So we're going to get through this as quickly as we can. So yeah, passport funding. So passport funding is funded by the Ministry of Community and Social Services, MCCSS. And the purpose and design of it is to help adults with developmental disabilities be more involved in their communities and to increase independence. So the way passport works is there is a minimum allotment of $5,500 per year. This has gone up from the initial $5,000 a few years ago and is now at $55,000. That's the minimum a person who is eligible to receive passport can receive. And the amount can increase based on the Disability Service Ontario assessment tool that's done by DSO. So that's a very common question is, how do you apply for passport? And that all starts at the Disability Service of Ontario level. Just keeping in mind that for people who are looking to be reassessed, there is a huge backlog of this assessment. So you're welcome to let us know if there's any questions on that, or of course, you can always reach out to your local DSO office for more info. Passport funding. So the vast majority of Kerry's Place individuals are signed up for the passport and receiving passport. And when they do that, when they're done all the paperwork and doing the intake and all that fun stuff, they're given a client number. And that is the tool that's used to basically track that person's money, their funding, as we go along. So how it works, the parent, SDM, Kerry's Place, staff, whoever, the individual in some cases, spends the money on programs for themselves, and then they file the invoice with the passport to get reimbursed. So the comparison that we use a lot when we're explaining this is passport is very much like benefits. You're allotted so much in your benefits, and then you go out and you utilize those services based on the parameters that are provided through your beneficiary, and then you, of course, get reimbursed after you receive those services. Passport's very much the same. You're given a passport funding allotment based on your assessment, and then that assessment is how much money you have to use based on the passport parameters, which we're going to talk about in just a second. Just some passport funding different setups. So there are different ways that a person can manage their passport funding. The three most common ones we see are on the screen here. So the first one is a self-administered funding option. This is where the parent, the sibling, the caregiver, the person managing the funds is the term that's used, PMF. They pay upfront for the services, submit the invoice, and then receive the reimbursement. There's an online portal where this is done, but there is also some hands-on receipt giving depending on the agency you're working with. So they do have the My Direct Plan portal, which is an amazing tool, but there is still some hands-on of transition of receipts and stuff like that. The other option everyone has is a transfer payments recipient, TPR. Formerly, this was called the TPA option. In this case, Kerry's Place helps to provide the activities, expenses, and submits the invoice to the supported person on their behalf, and then receives the payment directly, meaning you do not have to pay for the upfront costs. So again, using that example of your benefits, it's like if you went to your chiropractor and your chiropractor does direct billing for you, you got to your chiropractor appointment, you had your services, they do the billing, they collect the fees, and you didn't have to do anything. Lastly, the third option you have is there's actually a combination. You can have some of the money sourced in the TPA option, but you could also have some of it self-admin. And we do see this option where, you know, caregivers, SDMs, siblings maintain a portion of the funding. And this is, again, you know, as Ken and Osman were talking about earlier, you know, especially people who do go home periodically for visits and stuff, and then have Kerry's Place TPR the remaining balance. Just a few stats on Kerry's Place and Passport. So right now, over 260 of our supported residents utilize Kerry's Place as a TPR. Just over 80% are from our supported living and just under 20% from our community living. And we have seen a very steady increase over the years, especially during the pandemic. So this is a growing program. Biggest question we have, what can Passport be used for? So we're going to just go over these very briefly. I'll dive in with a few examples to help explain. Of course, at any time, if you have any questions, you know, you're happy to reach out to that info at Kerry's Place, or of course, if you are the self-admin option, you're welcome to reach out to your Passport agency. There's lots of webinars, videos, there's lots of stuff online, and we'll share those resources a little later on. First one we have is our programs, classes, and supports that help develop independence, social and life skills, community inclusion. So this can be anything from like a local sports group. I know a lot of places have Special Olympics or have a specially designed league for people with disabilities. It can also be to attend things like going to the movies, participation in community events and activities. So this could be going to museums, going to shows, going to the aquarium, going to Canada's Wonderland, lots of community access points, and the fees to get in there would be covered through Passport funding. Tickets for live events. This is mainly sporting, music, and live entertainment. So this would be going to see like a theatrical performance or going to a live concert. Passport does have a cap at 150 for the individual and 150 for support personnel. And the only thing the support personnel cannot be is a mother or father, but it can be a sibling, a cousin, it can be a paid for worker, it can be a worker through an agency. And again, they do cap those at 150. So then we move into things like arts and craft supplies. This was from our COVID addendum that has been transferred over to the new guidelines. This also includes things like movies, DVDs, comics, kind of that at-home leisure activities, puzzles, crosswords, all that fun stuff. Equipment required to community leisure activities. So not only is this things like fishing rods and sporting gears, but this is also, for example, going back to the Special Olympics, maybe we need to purchase a bat and a glove and a practice ball. Those things could be covered under Passport funding as well. Pre-employment and employment supports. This is a great opportunity for people who are looking for occupational employment. If you need to, for example, get a training done, or maybe you need to renew a certification, or even just attend an employment program, Passport funding can help cover that. We have transportation for employment and admissible activities. So the transportation guidelines have shifted over the last couple of years. This now does include things such as going to your place of employment, to and from. It can also be for some outings of returning to seeing family and friends. Again, these are things that have just developed over the last year, and they were because of the COVID addendums that have now transformed into the new 2024 guidelines. Paying a support worker to help with community participation in daily living activities or to do other activities not available at Kerry's Place. So again, as I mentioned about going to those shows and going to the theaters, attending that employment program, maybe it's a hands-on program like a co-op that requires supervision, having the ability to pay for those services, having that worker available. Passport is there to cover that. For those who use respite services, Caregiver respite is also admissible under passport funding. Technology, and I did see this pop up in the question box. So during COVID, they did approve things like video games and consoles and stuff like that. That has actually changed since the beginning of this fiscal. So April 1st, 2023. Technology is still admissible, but unfortunately, video games, consoles, and streaming services are no longer admissible. So things like Netflix and Spotify and Apple iTunes, those have all been removed. But tech items such as iPads, cell phones, TVs, DVD players, those are all still admissible. And just to add on to that as well, if you are getting internet services or a cell phone, if the person supported has those are also covered. Unfortunately, cable is not, but again, the internet, cell phone bills, those are covered. The person-directed planning is another one. And again, yeah, the technology seems to be a pretty big one. I did see in here a question about tutors. So some educational assistants are admissible. I would always recommend reaching out to the passport agency just to verify, but I have seen some continuing education supports covered through passport. Alrighty. So unfortunately, there are things that passport does not cover. So some of those things include housing and home maintenance. So this is things like rent, home renovations, modifications, housekeeping, things like putting in a ramp or grab bars. Unfortunately, those things are not admissible. Household items, electronics, furniture, and appliances tend to be the most requested. Indirect respite services. So these are things like cleaning, meal preparation, snow removal, care for another family member. Holiday travel, personal or family vacations, groceries, food and restaurant meals, items that may provide a sensory element such as furniture, permanent and semi-permanent structures of the household items. So an example of that is people have requested swings, outdoor porch swings, freestanding swings. Unfortunately, that is seen as a furniture item and is not admissible under the current guidelines. Clothing. So again, where we had mentioned that sporting equipment is admissible. In some cases, the uniforms can be covered. Clothing itself, everyday clothing is how it's worded, including winter jacket, hats, gloves, winter boots, athletic wear, yoga wear, swimsuits, gym shoes, adaptive clothing are not admissible. I would say if there is a specific clothing, especially if it's to do an activity, again, I would recommend reaching out to that passport agency directly. And then lastly, as I kind of mentioned, some technologies, products and services. So again, those gaming consoles, video games, in-app, TV and streaming are unfortunately no longer admissible.
All right, there's a bunch of how to get more information, but we also have a couple of questions really fast, and then we'll go to a wider Q&A session. Mindy asks whether passport can be used to pay for a support person help with daily physical exercise that may not be attended due to insufficient staffing at residential locations.
Yeah,
and
so
I would say yes.
In regards to physical exercise, yes. So we do have people who are receiving trainers, whether it be in gym, at home, whatever it is. Physical exercise is a great thing for a passport. So many benefits. But yes, I would say, again, something to look at, speak with your team. And yeah, that's great. And then I noticed here too, you mentioned internet and cell phones are covered, landline for connectivity. So that would be something we would want to reach out directly to the PA. When we've talked about phone bills, it always seems to be cellular. But again, we do know there are still people who do have landlines. So most of the time, as long as it is in the person's name, it would be covered under the phone guidelines. But again, that's something we would just want to go into a little bit more detail just to verify with the PA. And gym memberships, yes. So it wasn't touched on the slides, but I will add it in quickly. Memberships of a variety of categories are covered. So that could be your gym memberships, the access to entertainment card. It could also be a membership to a local club. If there's a fee that has to be paid, for example, Optimus, Lions, those are just some examples there. And we also want to touch on just music festivals, going swimming, mini golf, lots of sportsing stuff, and activity-based indoor and outdoor camps. So for those who do attend summer camps, those are also passport admissible, as well as day programming.
Thank you, Cody. That was great.
Thanks,
All right,
Lisa.
I think that brings us to the resources. We'll send this out to you, all this stuff. These are links, and Ken recommends government links more than other kinds of links because there's a lot of misinformation out there, like there is in the rest of the world. So these are the government sites, the passport sites, the Developmental Services Ontario site, and one private site that Ken recommends is this one about RDSP information. This organization in BC, he says, is very good, www.rdsp.com. That'll be up there when we post all of this, and we'll email it to you as well. So this brings us to the Q&A, the verbal Q&A. What I would ask is that people who have questions, put up your hand. And while you're doing that, we had the questions that came in by email. A number of you asked about disability tax credits. I hope that you've had your questions answered. That's Verma, Maria. If any of you, oh, there's a hand right there. That's Bob. Go ahead, Bob.
Yeah, thanks very much. And again, I appreciate this is very, very informative. And I'm sure everyone on the call really appreciates the time and effort that you're all going through on this. My question was, and I don't have my parents' will with me at the moment, but my parents have accommodated my brother in their will, set up by Bob Hart. And my question is, I know it was mentioned the Henson Trust. How do I make sure that my brother, that we have that properly
Stand
set
by
up?
Henson Trust. We're going to get to it after this Q&A. It's going to be important
okay.
too. And that I think you're going to
Spoiler alert,
there.
I've gone ahead, have I?
You've gone ahead.
Okay, thanks very much, though.
And not a problem. So anybody else have questions on what we have covered? The RDSP, yeah, a couple, Bob, that's an old hand, I imagine. And now you, Lisa, go ahead.
Okay. I know that you said we're going to be discussing the Henson Trust coming up, but so I'll ask my question now and see if we want to defer it. I want to know if I have a Henson Trust set up, say for $200,000, is there any benefit to having that put in an RDSP rather than a Henson? And also, is ODSP affected by a resident or loved one having a Henson Trust?
Do you want to handle that? Some of that is relevant to what we've just done.
Do you want me to?
Yeah, sort of the Henson versus RDSP issue.
Yeah, well, the Henson Trust receives an inheritance from the estate of the deceased parents. It's then administered by a trustee for the benefit of the beneficiary. And when the beneficiary passes on, pursuant to the instructions in the parent's will, it passes wherever they've directed it, which is to siblings or wherever it is that they've directed it. The RDSP, you're talking about an inheritance where there was no Henson Trust, which is quite common. That's probably the biggest part of our estate practice is all the people that call. I've had 3 consults so far this week on inheritances where there was no Henson Trust. And yes, you could plunk 200. Well, if the person's over 49, right? If they're 50, which could well be, then you could plunk 200,000 into the RDSP. And if they're over 49, then of course there's no grants and bonds if they haven't contributed. Well, you can see it's a bit complicated. You could certainly put up to $200,000 into the RDSP. It would be ideal if the person is over 50, because then you can put it in and withdraw it whenever you want. But you can also see that if the RDSP was set up earlier and there's 10 or 20 years worth of grants and bonds in there, and the following 10 years has not elapsed, well, then you could throw another 170, and let's hope it's only 170, because if it's more, you're still stuck. But you throw it in, but you can't take anything out without losing grants and bonds. So this kind of tactical question is a very good question, but it depends upon the facts of each situation. Like, for example, we have a situation where There's a boy, he's about 27 now. His grandfather died and left him 250 grand. Well, it's true. He could put 170 into his RDSP, but then you can't touch it until he's 60.
Mm.
So, and as well, it belongs to him. Now, here we're talking an inheritance outside of a will. So if somebody does die and they leave 250 grand to some person, some child, well, you have to find an exemption, right? So a big part of our practice is dealing with these exemptions. There's various tactics. But putting the money into an RDSP, if they're over 49, could well be a part of the tactic.
Mm.
If I could hold thoughts about Henson Trust and some of this to after. I know that Lisa, your thing sort of bridged the two. There's also Teresa has a question.
Oh, hello there. Thank you so much. This is so informative, and I'm just learning so much here. My question is, my son is currently at university. He's 21, fairly high functioning, but, you know, needs a lot of support, and we've been providing that for him on a regular weekly basis. You know, he's coming home on weekends and everything. So I guess my question is, this passport funding, is he eligible for this as well?
So I'm going to ask Cody to respond to that question.
Thanks, Teresa. Great question. So just to clarify, your son is currently in university.
Yes.
And has he ever applied to any services under DSO?
Yes. We had set up, had some respite, submitted it previously when he was younger, but not since, you know, he entered high school and then, you know, university.
Mm-hmm. So just to not take up too much time, as I know there's a lot of material to get through. If you would like to send a quick email over to the info@kerrysplace.org, I will get a copy of that email and then I can respond back to you directly. I'll just have a few follow-up questions, but the short answer I could say right now is supports inside the university for a person who does receive DSO funded supports would be eligible to use their passport funding to have a support worker accompanying them. But I also know there's a lot of universities in particularly that have really great programs for students with disabilities. And a lot of those are actually free of charge. So yeah, like I said, maybe some more follow-up questions, but that's the short answer. And if you'd like more info, we're happy to try to help you out with that.
Okay, sorry, can you repeat that email so I can follow?
We're going to show it at the end, Teresa,
Oh.
but basically it's info@kerrysplace.org. But we'll put it on the screen at the end.
Awesome. Thank you so much.
Oh, you're
Thanks,
welcome.
Teresa.
Linda, go ahead.
Yeah, my question is, I set up an RDSP for my son, and does it have a time constraint? Because when I filed those taxes, they said that he no longer qualified for his RDSP.
How old is he?
He's 18. He's going to be 19. Do we have to do it over, like send in, because he's got a permanent disability?
May I comment?
Yeah, go for it, Ken.
Yeah, what happens is, what I'm hearing is that you've applied and been turned down. Is that correct?
No, he was getting RDSP, and then the accountant, I guess, didn't provide it. I'm not sure, but they said that we got a form saying that there was zero amount in the RDSP, and that we had to submit another form again.
What I'm hearing is that the boy was approved for the disability credit up to a certain date by CRA, and that date is now passed. If that's the case, then yes, you have to file a new T2201, get the old one, which was approved, and fill out the new one just like it, and submit that.
Okay, I did that, and so I just have to wait until they approve it again.
Yes, that's right. If it's approved again, Don't let things slide. Just let some doctor sign this thing. You have to make sure that it shows that he's all or substantially all the time markedly restricted or needs constant supervision or can't set and keep goals.
So the doctor doesn't do this. We have to what do we have to submit then?
Well, it's a T2201 form. So Google
Okay.
T2201. And just don't leave it to the doctor to complete. That's all. You have to make sure the doctor fully, a lot of times the doctor doesn't know the child really very well. And the problem is if it's filled out and it doesn't say that he's all or substantially all the time, markedly restricted, takes substantially longer, needs constant supervision, or can't set and keep goals, and it's not approved, well, then the next time's even harder. So just get the old form that was approved, fill out the new T2201 the same way, and get a doctor to sign it like that.
Okay, I'm going to
Okay.
move on if I could. I see that Joanna has her physical hand up, and then there's Jared. Joanna, go ahead. And you have to unmute yourself. Do you know how to unmute yourself, Joanna? It should be at the bottom of your screen. See mute. You just want to click on that. Yeah, there you go.
Okay, thank you. My son has a passport funding for 1,500 per year, but his day program fee is 2,200 per month. So we pay a lot of money and the passport funding is not enough. I have a question. The balance, can I consider as a educational fund in the income tax?
I'll defer to Ken for that one.
You have an RDSP, is that what you're saying?
No. Passport funding only 5,500, and I have to pay out about
Oh, you
56,000 per year for his day program.
you'd like to get more passport funding.
They not approved now, but I still have out of pocket a lot. Can I put it as education in income tax?
Well, this is a passport question, Osman.
No, I think it may be
Passport.
about the extra money she's spending above and beyond 5,500.
Yeah, sure.
She
Lots of
wants to
grants.
know if she can do something in income tax for that.
As an educational fee?
No. I mean, if it happened to be medically related, you've got some relief there, but not much. No, this is just an expensive living.
But to improve his knowledge for independent though.
We understand, Joanne. I can interject here as well. So I think what the question is the difference of what you're paying and what you're covered for passport. You're looking to see if there's any income tax credits or deductions that you can apply to your income tax. And I think the short answer is no at this point in time. However, if there's something that's nuanced about your situation, I would urge you to contact Ken on your own so that he can provide you with a full some kind of overview of the situation and provide you the correct guidance.
Yeah, that's
I'm
right.
going to move on to Jared now. Sorry, we have to move on because time is tight.
Okay.
Yeah, Jared, go ahead.
Hello, thank you for this opportunity today. I just have a couple questions about the benefits. So what if our person down the road becomes in a common law or married relationship with another person with similar disabilities? Like, how does that affect the benefits to the individual?
Well, if this is the difference between two people independently receiving ODSP, right? And they're both getting 1308, hopefully. If they were to become a couple, then they would be what is called a double disabled benefit unit. And so they would receive close to the same amount, but it would be more complicated. It's less than 1308 times 2 because the shelter component is less. So what most people do is they become roommates or friends or house sharing. They don't mix their finances. They don't have joint accounts. They don't have an account that they both contribute to pay the rent. It's all kept separate and financially separate. And as long as you do that, the ODSP occasionally asks more detailed questions, but as long as you keep yourselves financially separated, then you continue to be two benefit units receiving the full amount that you should receive. If they decide that they wish to become a couple, fine. It depends upon their circumstances. Matrimony is a good, proper estate. You know, if you feel that your child should marry or be a couple, a partner, you have to look strategically at this, because in some cases, of course, two people have disabilities, but one of them has lesser disabilities and can help the other party do what the parents now have to do when they're gone. So you really have to look at this strategically. Tactically, it's true, if you're a couple, you get less money.
Thanks, Ken.
Yes,
All right.
thank you.
It's 8:35. Theoretically, we only have 25 minutes left, and I'd like to promise that there would be like a screen break. If people have, I'm going to leave it to about 1 minute because we are running late, just so you can move your eyes away from the screen, stand up for a minute, and get back. And if we can get back at 8:37, that would be great. So we'll see you then. We're now going to proceed. I hope everybody's rejoined us. And thank you for all your text questions on chat. Karen is doing her best to answer them, and those that she cannot do, we'll try and do verbally at the end after 9 o'clock. But I want to move on to the material that most of the people who have responded by email wanted to know about the Henson Trust and other estate planning issues. So this is called Planning for the Inevitable. You might as well move it forward, Osman.
Thank you.
And I think this is up to you there, Ken, to tell us about the Henson Trust. This is what most people want to know about.
That's usually the main draw, the main question, the first thing. And you can see here on the slide that Lise did, it's an excellent slide. You probably also heard about it. There aren't that many people these days that haven't heard about it. At least people may spell the name wrong, but that's fine. It'll Google just the same. The reason I first started doing this work back February 26, 1996, was that at the time nobody knew about Henson Trusts. They didn't know they needed one because, of course, it was recent case law. It was 2017, 29. 1985, 87, 89. Time goes by, eh? And they didn't know where to get one. So I thought, well, the firm motto is do good and do well. You can't consistently keep out doing good if you don't do well, as a saying. So we started to reach out to families, and our practice specifically reaches out to families we're limited to specializing in assisting families with kids with special needs and disabilities. And this is their first question. On our intake form, as you'll see on the next slides, there are certain specific wordings that have to be put in. It's all drafted into your will. Nothing is created while you're alive. I mean, there are certain unique circumstances where you do things while alive, but typically it's upon the second death of a parent, and the estate is divided, and the share for the child with special needs is then eventually transferred into a Henson Trust bank account and a Henson Trust investment account. There's, of course, a procedure for this whole thing. Let's go to the next slide. So on our family details intake form, which you'll find on the website, one of the things that it asks certain specific focused questions that allows me to then give a reasonable sort of reply. Are you doing this? You should do this. You don't do that. You know, and then if people want to have a longer discussion, we can arrange that. But do you have a will? Does it have a Henson Trust? Yes, no, unsure. And lots of people don't. Lots of people still don't have wills. But there's a lot of people who say unsure. And the reason for that is that they are unsure. They may know or think they know that they did something special, but they look at their will and it's not titled Henson Trust in the trust section. So they don't know. And of course, they don't know the legalese that is required. So we find situations where people are unsure, but yes, they're okay. But the wording to look for is absolute and unfettered discretion. What this is the discretion of the trustee to invest and disperse funds. And the reason it works simplistically is that if the trustee has this complete discretion, then in law, it's extremely unlikely, almost impossible, for the person who is the beneficiary to compel the trustee to give them money to support themselves. So in a normal trust, for an asset in excess of 100,000, and these days these trusts are all over $100,000. There's $100,000 non-absolute discretionary trust, which would be okay. We still see those from time to time where the estate is divided and the trust for the child is limited to 100,000 because someone has told the parent that you can only have 100 and not lose benefits. If you have an absolute discretion, then ODSP can't cut off your benefits to try to compel you to get the trustee to support you. And this is what the common law established. And now it's established in all of the provinces, including Quebec. It's all provincial common law. And it's also been to the Supreme Court of BC with respect to, does it affect guaranteed income housing? So it's there's no question about it. And used to be that we would have questions. Well, do you think they'll change it? Because of course, they'd like to try to cut people off. Well, I just don't see this happening. The other clauses are no share of the income or capital shall vest in my said son, and the only interest she shall have is the amount actually paid to him or for his benefit. In a normal discretionary trust, the trust is legally held by the trustee, but beneficially, it belongs to the beneficiary. If you're entitled to your mother's house, beneficially, it still belongs to her, but it's in your name. So that's what the beneficial interest means. What this does is it means that the beneficiary has no interest in this. It's just not his property. And eventually it passes and it becomes vested in whoever receives it pursuant to the terms of the trust residue clause. There's no limit to the size of a Henson Trust. There's no practical limit to how much can be distributed for the benefit of the beneficiary. That's the most common misconception. People still say to me, yes, but the trust can only distribute 10,000 over 12 months. Well, that's not true. You can read this, take a moment to read this. You'll see the section here, it says the first 24,000 of income is shielded from tax. What that means is that the trust is set up, say it has $500,000, and it's pretty easy these days for the trustee to invest it at 5% and to generate $25,000 of trust income. Now you want to be able to use this money plus the capital for the benefit of the beneficiary. And the big advantage up until they turn 65, when you have to change tactics, is that they have a personal tax credit of 15,000 plus a disability credit of about 9. So they have about $24,000 in tax credits. So what you do is you use a preferred beneficiary election to attribute this income each year to the child. The money is not actually received by the child, but it's attributed to them. It's put on their tax return. And because of their tax credits, there's no taxes paid. So this is good. You get to provide for your beneficiary sister with after not taxed dollars. And that's what that part means. Next slide. Okay.
Oh, before we, yeah, that's it for Henson. But Vanessa had a question. If the assets in the Henson Trust belong to the estate, what happens when the estate is wound up?
Oh, they're transferred out of the estate, and the estate is wound up, and they're transferred into the trust, which is a separate entity. It
All
just
right.
rolls along until the beneficiary passes.
All right, I'm going to move on, but we can get back to Henson Trust. If people have Henson Trust questions beyond what Ken did, we'll get to them in about 10 minutes when we get through the rest of this stuff. There's just a few other things to keep in mind in planning for when we're not here. And one of them is pension, and Ken, you can speak to this.
Yeah, this is something unique that people just aren't aware of. If you have a provincial statutory pension, not a federal pension, not all provincial pensions, not by any means all private pensions don't have this. If you have a provincial statutory pension, which is a public service pension, OPSU, teachers, OTIP, OMERS, municipal employees, OPG, power generators, workman's comp, those types of employments, you have a pension when you retire. And if you have a spouse, when you die, the spouse gets 2/3 of your pension. Well, if you have an adult dependent child, for example, a child still living with you, or a child at Kerry's place, more specifically, and if you are making use of the disability tax credit, and the Canada Revenue has agreed that the credit is transferable to you because you're helping with the necessities of life, then these other pensions have a pension that is possibly available, quite possibly available, for your adult dependent survivor adult child, and it's approximately 50% of your starting pension. So you can see that, for example, think how many teachers there are. Is there one for every 30 school-age child? Think of how many municipal employees there are. How many public servants? It's millions of people. And so potentially their pension, when they retire or when it's passed on to a spouse, if they have a spouse, when they pass on, if certain paperwork is done, then it's possible for that child to receive half of, for example, a $60,000 teacher's pension. Now, there are certain preparatory things you can do. You can't get this established while you're alive, but there are certain preparatory things that we guide you to do. And one of the things to keep in mind here, along with other factors here, and you'll see more of this when we get to the legal guardianship section, the people at Kerry's place couldn't obviously potentially know about this or apply for it or manage the money, which is then paid directly to them in their name, let's say. So you need a legal guardian to become the personal representative of the person at Kerry's place, to apply for the pension and then to receive it on behalf of the person and to use it if needed. Again, it is income to the individual. So they'll have $30,000 of income, but of course they have the $25,000 of tax credits. Becomes slightly more complicated. I'm looking forward to finding out how Kerry's place will respond financially to someone who then has a legal guardian and receives $30,000. We know that things change when somebody turns 65. And how Osman will tell us how the Kerry's place will deal with OAS-GIS. What happens?
We're going to get there.
What happens when somebody has a $30,000 pension? So it's fascinating, and of course, really, I know for a fact that people just do not know about this. These are all intelligent people, right? If you have a double teacher marriage, then there would be half of 2 pensions. I think I'll stop here.
Okay. Other ways to plan for income after you're gone. Insurance.
Yeah, this is interesting. Lots of people have a modest estate. If you happen to be a single mother who's 50, you could buy with a life insurance premium of approximately this amount, an annual premium You could get a universal policy with a fixed premium until the day you die that pays 100,000 or multiples of 100,000. And of course, if you're one of the 14% of families in Ontario whose child lives with them and will live with them until they pass on, then you can see that you're receiving the child's $9.95 a month or $13.08 a month. So you can certainly cover a premium. And this is the annual premium. I'm sorry, this is the annual premium. So you can see that it's entirely possible to cover this kind of premium. And what this would do would be directly designated to the Henson Trust in the will to receive whatever modest share of your estate there's going to be. And it typically, no reason it couldn't be paid to the trust within 30 to 60 days. So it's a quick way to arrange for some money if you also have to apply for probate to handle, for example, the sale of a home. It's also a good way if you're in a new marriage to segregate your concern for your child from your previous marriage who has special needs by buying life insurance. And the couple who now are a couple and perhaps have a 6-year-old now, along with a 27-year-old and a 22-year-old from a previous relationship. If you're particularly concerned about that 27-year-old boy from the first marriage, one of the ways to segregate your concern and to enter into that marriage with an open heart is to buy $500,000 worth of life insurance, because you know that this will fund the trust for the boy when you die, your son, but everything else you can leave to your wife, because you have a responsibility to also provide for her and your 6-year-old daughter. So insurance is a very interesting thing. And then on the next slide, this is what I refer to as my whimsy. I thought, well, what happens? That seems like a high premium. Should it really pay? Is it worth it? And if you take that annual premium and you tuck it into a TFSA every year, so it's not taxed, and you invest it at 4%, and 4% is conservative these days. Well, if you're 50, female, non-smoker, you're supposed to live for about 35 years. So if you were to invest this for 35 years at 4%, turns out that it's calculated to be about $107,000 compared to the $100,000 death benefit the year after you put the insurance policy in place. Then you're putting together investing the same amount, this $13.85. So basically, if you give $13.85 to an insurance company, the odds are that you're going to get exactly what you would have gotten if you'd invested it and died pursuant to the actuarial terms, but you're covered in case you die sooner. So I just thought this was fun. It's my sense of humor.
All right, decision making. Once we go ahead.
Is this me?
Yep.
Yeah, it's you. That's
Okay.
a biggie.
Well, the decision making part of it, the substitute decision maker is a family member, a parent for sure, and then a sibling if there's siblings and so on. And you'll see the tree for the substitute decision makers in a second here. But if a person is not competent, like individuals at Kerry's place, then the Healthcare Consent Act provides that solely for medical purposes, there's a tree that shows who is their substitute decision maker for personal care. And that would, of course, firstly be the parent. There's that.
I can touch on this piece here from a Kerry's perspective.
Can you go back one slide for a sec?
Yeah.
And then that's perfectly fine. But if a person's not competent, in most cases, what you're going to need, once the parent gets to be what we call the awkward age, which is about age 65, let's say, is in order to make a real, proper, smooth transition of care, you're going to die, right? You're the SDM. Yes, it's true that now his brother, becomes his substitute decision maker solely for medical care. That's true. But what many people feel sleep better having done is setting up a legal guardianship. It's an application to the court where the parents and a sibling or some family member or perhaps a cousin, family friend are appointed by the court as the legal guardians of property and personal care. And this is something that you can get notarial copies of and put in the face of people who don't listen to you. So for example, you have a guardianship and your child or your brother happens to have health issues, right? So you're dealing with doctors and hospitals more frequently than anybody would ever want. And so if you provide them with this, then they must listen to you. They must disclose information to you. And if you just simply start using the phrase informed consent, you are the one that must give informed consent to all treatments. And this is the catchphrase that alerts the doctors and the hospitals to the fact that you have a guardianship, there was a lawyer involved, you know about informed consent. So all of a sudden they start to tell you things. The fact that you're just a substitute decision maker parent or even less sibling doesn't mean that they're going to do anything other than treat you as just sort of peripheral. But a legal guardian must be listened to because you stand in the shoes of your sister. And the medical system is biased against old people and people with disabilities. It's the triage system. And the attitude, briefly, is that you've got these three buckets, and here's a bucket of people that can be fixed. Here's one of people that probably can be fixed if we put enough resources into it. And here's another bucket of people that either we're not sure if we can fix them or is it really worth doing it? You know, is the bicycle broken? Why fix the tires, you know? And the medical system is based on this, and it's biased against older people like me and people with special needs. And it'll be biased against you when you're older too. Anybody here who has a parent that has had medical issues understands how this works. The third option, as you can see here, is what you have. And your option is you have a power of attorney appointing someone, your spouse, and then you also have a will. But of course, the people at Kerry's place, as I understand it, are not competent to sign powers of attorney. That's it.
Thank you, Ken. And from a Kerry's Place perspective, we operate and our policies are informed by the Ontario Healthcare Consent Act, where the closest living relative to the current decision maker would be the automatic substitute decision maker. And usually this is essentially going to be either a spouse in some cases, but more so for the individuals that we support here as well, a parent, a sibling, or a child of the decision maker that has passed away. So upon the death of the decision maker, Kerry's Place would automatically identify who that new SDM would be based on the Ontario Healthcare Consent Act and based on the hierarchy you see on your screen here. Now, I would like to just point your attention to the green section there where it lists spouse and partner, parents and children, siblings, and any other relatives. These are the automatic family members that we would consider to be the SDM. Above them are some of the appointments that Ken just spoke to as well, which are the legally appointed guardians or representatives that are appointed by the Consent and Capacity Board. Now, one might wonder, how does one get appointed by the Consent and Capacity Board? Well, that's what my next slide is going to kind of guide us through here. So there have been situations where two or more people are entitled to be an SDM and they have the same rank on that hierarchy on the chart that I shared with you on the slide prior. And there's a bit of disagreement as to who the next decision maker should be. In this instance, an application can be submitted to the Consent and Capacity Board, and they will be the ones who will make that decision. And I just want to stress that this happens very rarely at Kerry's Place. Some families do take some initiative in that they would be taking the steps to legally recognize an SDM or a guardian while they are still alive. And as a last resort here at Kerry's Place, the public guardian and trustee would be sought to act as an SDM if there are no living relatives that are available, no willing relatives that are available, or there aren't any legally appointed guardians. Over to you, Ken. Legal guardianship.
The legal guardianship process is an application to the court. And it's necessary for various things. Usually the parents can muddle through. For example, in the Kerry's Place situation, you don't need to be the ODSP trustee for the money. You could be, certainly, of course, you do have substitute decision maker authority to some degree if the person is not competent, which they're not in this case. That's as to medical care only. You can be the account holder for the RDSP, but when they turn 60, the checks start to be issued in the name of the not competent person. How do you deal with that? As far as Canada Revenue is concerned, it's true, at least I've been told, that people do file tax returns for people who are not competent and who therefore could not authorize them as representatives for Canada Revenue. Parents usually have no hesitation doing this or are happy to turn a blind eye. It's perhaps less common for a sibling to want to pretend that they're the not competent party for Canada Revenue purposes. But of course, you have to file their tax returns, especially if they're under 49, because if you don't file the tax returns, they don't get the grants and bonds for their RDSP. And if you're talking about pensions, you have to be there available to apply for the pension and manage the payments. It's basically,
I think we should get back to why legal guardianship, right? I think that's the real focus here. Why legal guardianship versus just leaving it as the SDM?
Well,
I think a lot of families find themselves in a situation where it isn't entirely clear who the next SDM is. And that's the family that wants to go through the process of appointing a guardian.
Yeah, and it's only as to medical care.
So as it says here, if you appoint, if it's not clear in your family who's going to be that next SDM based on the chart we just saw, it's a useful thing to apply for legal guardianship. And Ken, as Ken was saying, it's about financial. This is about basically making all decisions from what I think we were told.
Yeah.
Including financial decisions. You are the person making the decision for that person. So I don't know, Ken, how very quickly, since we're at 9 o'clock, is it a complicated process to become a legal guardian?
Well, I've never seen an individual do it themselves. So it's a legal process. If you know what you're doing and you can handle it, setting up the capacity assessments, and you know how to make the application, and you know how to file it online, and you prepare a management plan and a plan of care, I suppose a person could do it. I've never seen anybody do it.
So in other words, you go to a lawyer, possibly you, possibly somebody else, and do an application to be to appoint someone to be a guardian for your supported person.
Yeah, in practice, that's the case. It's like when somebody dies, do you do your own probate application?
Right.
Probably not.
All right. So yeah, there's a common misconception out there. Even as we started doing started preparing for this town hall, everyone always thinks of the word power of attorney, that they want, to appoint a power of attorney for their child or sibling. The key thing here is that, and Ken, you can speak to this, power of attorney is not applicable to the people that most of us support.
No, I trust that everybody taking part today has a power of attorney, reciprocal power of attorney with a spouse or friend, and a will. And of course, you can only do these things if you're competent. If you're not competent, like people at Kerry's place, then you simply can't do it.
So that's where the guardian process is better. It's better to appoint. That's where the phrase appointing a guardian, if you're not sure that somebody in your family is going to be made the automatic SDM.
I mean, we can discuss it. We try not to have to have people do it, right? We try to muddle through because there's expenses involved in a guardianship application. So we try to make sure that people don't need it if it's at all possible. But the day comes when people get to be what we call the awkward age, when they're concerned about the transition for when they're gone. they've made a transition arrangement. They have a Henson Trust in their will for financial assistance. But okay, we're gone. Who do we know for sure is going to take care and watch over my child?
So questions. Now I know Linda's had her hand up for about 10 minutes. So this is the time for questions on what we've just done.
Yeah, my question is, to appoint a legal guardian, can they be someone that doesn't live in the country?
Yeah. Yeah, we've done Australia, New Zealand, Britain, Romania. No, that's a little harder. The States, certainly.
Okay. Thank you for that answer.
To the question about the Henson Trust, we've answered that question already. What happens to the funds inside the Henson Trust after the beneficiary passes away? Actually, we have not. That one. What happens to the funds inside the Henson Trust after the beneficiary passes away?
Well, it's the estate of the deceased. They're not competent, so they have no will. And this is happening now, and it will happen lots more. It's going to be a more, as I said, a sizable estate. You know, we're talking people with a $700,000 asset, and they're not competent to do a will. So they die intestate, meaning no will. And then by succession law, that same chart that you saw, well, a very similar chart to the chart you saw for the SDM, that's also the succession law chart. So if a child dies, and this has happened, the child dies, he's 35, he's had an RDSP since 2009. And of course, a number of the grants and bonds are not vested, right? So they all get taken back by the government. And what comes out of it, somehow, is the money that the parents have contributed, plus the growth, plus the grants and bonds that are vested, that have been there for 10 years or more. So it would often, in today's world, be an amount that is, say, $87,000, but you're going to lose $45,000 of grants and bonds. And what's left is the money that the parents have put in, plus the growth, and perhaps some vested grants and bonds. So it's a small amount, really. And what we're now struggling with is by intestacy, it goes, and succession law, it goes to the parents first, then it goes to the siblings, then it would go to the children of the siblings if the siblings are deceased. So it's, you know, similar to the SDM chart. And there's more to it than that, because of course, lots of people don't have siblings. Well, where does it go then? Well, there's a tree for it. It goes up and over and down to cousins. But what's happening is the estate sections of the banks and the RDSP sections of the banks have no experience with this, because people until recently didn't have RDSPs and didn't die. So now people are passing on. You know, they're elderly or they're in their 30s, and for some reason they've passed on. So what's happening is the banks have this knee-jerk response saying that the parent has to apply for probate. Well, you don't want to incur the cost and time involved in applying for making a probate application to appoint the executor without a will. It's an intestacy administration of the estate appointment, because the legal fees are legal fees, you know, that you'd rather not pay, and you're only going to get $30,000. So we're in the process on a daily basis of educating the banks and the RDSP sections and the estate section that what is really required here is simply an indemnification and a release, where the money goes back to the parents and they sign a document saying that if anybody else makes a further claim that is founded, that they'll pay the bank back. And this is how we have always dealt with these small amounts of money. A fellow dies, everything passes to his wife by succession and joint ownership and designation. But, oh, he's got a bank account that's in his name only with $40,000. Well, you don't want to apply for probate to just get 40 grand. So historically, you know, for decades, you've been able to simply get an indemnification form and for the bank The bank managers generally did have experience, but we've had a great turnover, and a much younger cohort are working at the banks. And of course, their parents are still alive. They've never dealt with an estate. So there's very little real experience in these matters. And so they just knee jerk and say, oh, probate, and this doesn't make sense. So what we're doing is we're just gradually educating the banks. If you were dealing with a financial advisor, for example, investors group or someone with some financial organization, and the money is placed with, the RDSP is placed with Mackenzie Financial, for example, those groups and those organizations, they understand that you don't need probate. They're a little more educated than the bank officials. So we're gradually getting there, but you can
Okay,
see.
I'm sorry, I'm gonna cut you off, Ken. I'm sorry as you're finishing up that thought, just because we have so many other questions and we really are at past time now. Joe Huggins asked about does the new CRA-T3 RET trust income tax and information return require to be filed for an RDSP and a Henson Trust?
I'm sending an email out tomorrow, John, just exactly this in much more detail. If it's because it's complicated. If you were
Okay.
to go to the website and download a book or sign a contact form or something, then you should get the email tomorrow. And if you don't, just send me an email and I'll send it to you.
We'll talk about getting on Ken. Would this be in your newsletter, your e-newsletter list, Ken?
Yeah, anything that you do on the website, a subscription, download a book, contact me and say, hi, Ken, I was at the session last night talking about Bear Trusts, and we'll reply.
Okay, maybe move forward the Osman. Would you like to move forward the slide a bit for a sec? So yeah, this is contact information for stuff about Passport and Kerry's Place. It's info@kerrysplace.org. I put that in the chat. Keep going, Osman. For Osman, anything he said tonight, or if you have dealings that are very Kerry's Place oriented, osman.gelle, kerrysplace.org, and cody.miller@kerrysplace.org for passport questions. Keep going. And now Ken was talking about there's www.kpopelaw.com is where you go to his website. You sign up for e-newsletters, which I would highly recommend. We will recommend it too in a note that goes to all of you registrants after, because you may not think about the stuff now, but you may really want to know about the most up-to-date law 5 years from now. So it's a good idea to get the e-newsletter, especially in a case like the question that was just asked. If there's up-to-date information, that's how you get that kind of information.
Yeah, I see that Karen has just put a note in the chat here. The best address is not me necessarily. It's either something on the website or Kevin at
Kevin at, yeah, all right. Kevin at kpopelaw.ca or Karen at kpopelaw.ca.
Yeah, I mean, I'm happy to respond, but I'll get overwhelmed, and they can respond to many things themselves.
All right, and I just want to put in a plug, talking about plugs, for the Family Advisory Committee. We brought you this, and there is the lovely Family Advisory Committee there. And you too, anybody on this Zoom can be on the Family Advisory Committee, and we would love to see you on there. So if you're interested in joining us to do things like this or other things of interest to other families, fac@kerrysplace.org. Please email us. We need more people. Join that lovely group. Now, we have a couple minutes. We are theoretically done, but if there's a burning question, we'll take a couple more. Any burning questions out there? Maybe you're all done. It's a lot of stuff, right? All right, so as Osman, if you want one more slide, I think there's one more, maybe. Oh, maybe not. Okay, so what we're going to do with all of this is we're going to send the slides and the video to all of you. in the next couple of days with a little survey about what you liked, wanted to know more of, didn't like. If you have ideas for other town halls like this, we want to hear about them. So you'll be getting that shortly. Unless there's any other burning question, you're all
Now,
welcome to stay
now
and
these-
chat if you want to, if you want a few minutes of chat.
Now these, what I find is that the webcasts that I do, people often watch them, several of them. So if you were to do one of these sessions again, for example, at lunchtime, you'd
Mhm.
still get people second time plus new people.
Yeah, that's a really good point. So we'll ask that question too in our survey if you'd like to, if you'd like another one like this, but slightly different, we'd be up for that as well.
Yeah.
Yeah, good point. Okay. No more questions? All right. Well, listen, thank you, everybody. It's been a pleasure for us to do this, and I hope it's been helpful. I think we're going to sign off now.
On behalf of Kerry,
I
Space,
think
have
on
a good evening,
behalf-
everybody.
I think on behalf
Thank
of everybody,
you.
we thank you, Lise. Thank
Oh,
you for doing this.
Oh, you're welcome. It's been fun. I mean, I
Thank
learned
you
a
very
lot.
much.